Are you a notary ready to move beyond the basics? Don't get caught unprepared with legal risks and client pitfalls. You need a blueprint for success. Introducing Notary Knowledge Reference Guide and Notary Bible. This is your essential playbook. Learn to master your duties, build a thriving mobile business, and protect yourself from costly mistakes with expert advice. Find Notary Knowledge Reference Guide and Notary Bible by Derek Spruill from Amazon.com, Barnes & Noble, Books of Million, Bookshop.org, Mobile Notary by DerekSpruill.com, or download from Kindle today.
Welcome to Notary Knowledge, and we are thrilled you're tuning in.
Absolutely. We have a fantastic, really fast-paced and informative show lined up for you today.
We sure do. Today, we are taking you right up to the finish line of major real estate closings. Usually when you reach the end of a massive, life-altering goal, there is this collective expectation of a simple climax.
Right, like crossing a physical ribbon.
Exactly. Think about running a marathon. You cross that line, the crowd cheers, someone hands you a shiny medal, and it is definitively over. It is binary, right? You finished.
Yeah, the human brain loves that kind of neat closure. We really want that cinematic ending where the struggle just instantly turns into a celebration.
Right. But then you step into the world of major financial transactions, specifically buying or refinancing a home. You have spent months hunting for a property, packing up your entire life into cardboard boxes, sweating over your credit score.
Oh, yeah, the stress is real.
It is. And then you finally get to the closing table. You sign your name 100 times until your hand literally cramps. You pop the champagne. But the reality, that finish line is a complete illusion.
It absolutely is an illusion. What feels to you like this single concluding moment of signing your name is actually just the starting gun. It kicks off this massive, heavily regulated, invisible machinery working right behind the scenes.
And that is our mission today. We are taking a massive stack of fine print. I am talking federal compliance manuals from Truist, government forms from the CFPB, dense legal indices from the NCLC Digital Library.
It is a lot of heavy material to sift through.
It really is. And we are extracting the essential knowledge you need to actually understand what is happening while you are holding that pen. Because understanding this ecosystem is the ultimate shortcut to protecting yourself.
Exactly. It is how you protect yourself from fraud, how you ensure legal validity, and how you leverage federal safety nets when things just go completely wrong.
Yeah, and before we jump into the mechanics of that, we want to remind you to grab the Notary Knowledge books by Derek Spruill. They are an incredible resource, so make sure you visit the Notary Knowledge website to get your copies.
You really do not want to miss out on those, especially if you are serious about this field.
So let's start with the physical mechanics of that so-called finish line. You sit down and you acknowledge your closing disclosure, which we will just call the CD.
Right. The CD, the document that spells out exactly what this loan is going to cost you.
Yeah. Now, instinct says, great, I agree, let's sign the final loan documents right now and hand me the keys. But the federal compliance manuals explicitly say no. You actually have to wait.
Yes. Once you receive and acknowledge that CD, federal law mandates a strict 3-business-day waiting period before you can sign your final loan documents.
Which, put yourself in the buyer's shoes. That feels agonizing. You have the movie truck rented, you're ready to go, and the government steps in and says, hold on, take a breath for 3 days. Why introduce that friction?
Well, it comes down to the psychological pressure of the closing table. Historically, people were sitting down to sign, and lenders were sliding entirely new terms, higher interest rates, or surprise fees into the final paperwork.
Oh, wow. Right at the last second.
Right at the last second. And the borrower, with that moving truck idling outside, felt completely trapped. They would sign terrible, predatory loans just because they felt they had absolutely no other choice in that moment.
I would probably panic and sign, too.
Exactly. So this 3-day window is a legally enforced cooling-off period. It forces the lender to lock in the numbers, and it gives you time to actually read the terms in the quiet of your own home.
Away from a high-pressure sales environment. Okay, that makes a lot of sense. It is a forced pause to break the momentum of a potentially predatory situation.
Precisely. It is friction by design.
So let's say those 3 days pass. You come back, you sign the massive stack of loan documents. You think you bought a house, but you really haven't yet, have you? Because those documents have to go somewhere.
Correct. You haven't bought anything yet. Those original, freshly signed documents need to be securely delivered back to the lender's funding department.
And that takes time, right?
Yeah, depending on the time of day and where you physically sign them, you have to allow 24 to 48 hours just for the lender to receive them and put them on a desk for review.
And what exactly is happening at that desk? The real estate guides mention something called prior to funding conditions, or PTF conditions. What is the funder actually looking for during that 48-hour window?
So the funder is basically acting as the ultimate quality control auditor. They're not looking at your credit score anymore. They are looking strictly at the execution of the documents.
So they are checking the paperwork itself.
Exactly. If everything went smoothly, these PTF conditions are primarily about verifying the notary and escrow documentation. They are checking to see if every single signature is on the correct line, if the dates match perfectly.
Basically making sure the notary did their job right.
Yeah, making sure the notary stamp is legible and unsmudged, and if every legal requirement of the signing ceremony was executed flawlessly.
So they were essentially hunting for typos and miscommas before they wire hundreds of thousands of dollars.
Precisely. Because a single missed signature can render a document legally unenforceable.
Well,
Once the funder reviews those PPF conditions and gives the green light, then we move to the next phase, which is lender funding.
lender funding. That is the moment the mortgage company actually sends the money to the title or escrow company, right?
Yes, that is when the wire transfer happens.
And the guides note this usually happens 1 to 2 days before closing. So the escrow company is just sitting on a massive wire transfer, waiting for the final domino to fall.
Yes, and that final domino is recording.
Recording the deed of trust. This is a concept that I think gets glossed over a lot. People assume that once the money changes hands, the house is theirs. But why is the physical act of recording so crucial to this ecosystem?
Because until it is recorded, your purchase is nothing more than a private agreement between you, the seller, and the lender. It is basically a secret.
A very expensive secret.
Exactly. Recording your deed and your mortgage with the county clerk fundamentally changes the nature of the transaction. It transitions the property exchange from a private contract into an indisputable public record.
You know, it is almost like a marriage. You can have a private ceremony in your backyard, but until you file the license with the state, you aren't legally afforded the protections of marriage. It has to be public.
That is a really brilliant analogy. By making your deed part of the public archive, you instantly minimize ownership disputes. If the seller tries to sell the house to someone else the next day, the public record proves you already own it.
Right, the county has the receipts.
Exactly. Furthermore, it records the exact identity and priority of your mortgage lender. If the lender ever needs to foreclose, or if you want to sell the house later, there is a perfect, unbroken chain of title verifiable by anyone.
So the lender will absolutely not allow the escrow company to release the funds to the seller or give you the keys until that public recording is confirmed.
They will not. They need that public guarantee.
Now, I was reading about the actual logistics of this in the real estate guides, and they mention a difference between a special recording and just a standard recording. What is the difference?
Right. So a special recording occurs when a specific county allows the deed to be recorded on the exact same day that the escrow company receives the wire from the lender.
Which sounds ideal. It expedites the entire process, right?
Yeah.
Same day funding and keys.
It is ideal. But you have to remember, not every county operates like a well-oiled machine. Far from it. Many counties do not allow special recording at all.
Oh, really? So you just have to wait.
Yeah, or they might have strict cutoff times, like 2:0 p.m. If your escrow company receives the funds at 3:0 p.m., your deed will not record until the following morning.
Okay, let's paint a nightmare scenario for a listener. Let's say you schedule your closing at 4:0 p.m. on a Friday. And not just any Friday. It is the Friday of a 3-day holiday weekend.
Oh, if you do that, you are actively courting disaster. The recording process is handled by local government officials who work standard municipal business hours.
Right, they want to go home for the weekend too.
Exactly. If you close at 4 p.m. on a Friday, the wire might not hit until Monday, but Monday is a holiday. So the county clerk isn't at their desk until Tuesday morning.
Meaning you, the buyer, are sitting in a sweltering U-Haul truck with all your worldly possessions locked out of your new house for 4 days, all because of the municipal hours of a county clerk.
Exactly. It really highlights how tethered this massive financial transaction is to the physical human reality of local government. The absolute best practice is to schedule your closings early in the day and early in the week.
That is such a good tip. Early in the day, early in the week. All right, here is a piece of this timeline that I found genuinely fascinating because it bends reality a little bit. It is the illusion of the first mortgage payment.
Ah, yes. This trips up so many people.
Let's say I manage to avoid the holiday weekend trap. My loan record's perfectly in mid-October. When is my first mortgage payment actually due?
Your first mortgage payment would not be due until December 1st.
So this is where people get incredibly confused. I close in October. I don't have a payment in November. My first payment is in December. It feels like the bank is just giving me a free month of living in the house.
It feels like a gift, right? Like you have time to go buy some furniture. But it is entirely an accounting illusion. There are absolutely no free months in real estate finance.
So what is actually happening?
You have to understand that unlike rent, which you pay in advance for the upcoming month, mortgages are paid in arrears.
Paid in arrears, meaning backwards.
Exactly. When you make a mortgage payment on December 1st, you are not paying for the privilege of living in the home during December. You are actually paying the interest that accrued during the entire month of November.
Okay, so December 1st covers November. But what about the back half of October, when I actually moved in? Did the bank just forget about those 2 weeks of interest?
Oh, absolutely not. The bank never forgets interest. The interest for the days you own the home in October was collected upfront at the closing table.
Oh, so I already paid it.
Yes. If you look at your final closing costs, you will see a line item called prepaid interest. The bank calculated exactly how many days were left in October, multiplied it by your daily interest rate, and made you pay it in cash before you even got the keys.
That is brilliant, but it is such a trap if you don't understand it. The gap in November isn't a free month. It is just the mechanical reality of how interest accrues and when the billing cycle aligns.
Precisely. It is just math catching up with the calendar.
Speaking of traps, there is a specific story I want to run by you that connects to property taxes. Picture this. A listener buys a house, moves in, and they are 6 months into home ownership.
Okay, they are settling in.
Right. They have painted the living room, they are finally feeling comfortable, and then they open their mailbox to find a bill from the county for $3,000 due in 30 days. It is a supplemental tax bill.
That is a terrifying piece of mail.
They panic because they thought their mortgage lender was supposed to be paying their property taxes out of their monthly payments. Why does this happen, and who messed up?
It is a terrifying moment for a new homeowner, but the reality is nobody messed up. It is a built-in lag in the bureaucratic system.
A lag. How so?
Well, when you buy a home and use an escrow account, your mortgage servicer does pay your county taxes for you. But right after you close, the county's records have not yet updated to reflect your new purchase price.
So the county is still taxing the property based on what the previous owner paid for it, maybe a decade ago when it was worth half as much.
Precisely. So your lender pays the upcoming tax bill based on that old, lower assessed value. But local governments are very good at collecting their money.
They always get their money.
Always. Eventually, sometimes 6 months or a year later, the county assessor gets around to updating the property value to match the higher price you just paid. And they realize they were shortchanged for the past 6 months.
So they just send you the bill for the difference?
Yes, they calculate the difference between the old tax rate and the new tax rate, and they issue a supplemental tax bill directly to you to make up that shortfall. Your lender didn't collect enough money to pay it because they were legally required to base their initial estimates on the currently available public data.
Man, so it is just a surprise bill. What if the opposite happens, though? What if the lender overestimated and overcollected?
If the lender overcollected based on their estimates, you might eventually receive a refund check directly from the county tax assessor's office. But the guides offer a very stern warning about this. Do not immediately go spend that check on a new television.
Why not? I mean, if it is a refund, it's my money, right?
Because local tax assessments are incredibly fluid in the first year of ownership. The county might reassess again, or realize an exemption was improperly applied, and they will come right back looking for that money.
Oh, that would be awful.
It happens. It is highly advisable to put any surprise tax refund into a savings account for at least a year.
That is a fantastic pro tip right there. Keep it in savings. Now, before we dive into the next massive ecosystem operating behind the scenes, we want to share something really exciting for the professionals out there.
Yes, this is huge. If you are doing this work, you need to check out the One Ledger Notary e-journal on the Apple App Store.
Yes, it was crafted by the amazing Magnificent Works team, and it is a total game changer for keeping your records secure and compliant. And right now, you can use the code NotaryKnow50 to get 50% off the first year annual plan.
That is NotaryKnow50 for 50% off. It is an incredible tool.
Absolutely. Okay, we are back. You mentioned escrow accounts just now. which provides the perfect segue. We need to talk about TRIDE, the TILA-RESPA Integrated Disclosure Rule, and the intricate world of escrow.
TRIDE is basically the regulatory framework that birthed the closing disclosure we discussed earlier. It is all about transparency for the consumer.
And a massive part of that transparency revolves around these escrow accounts, right? Which the federal guides sometimes refer to as impound or trust accounts. Let's define the mechanics of an escrow account, because for a lot of people, it just feels like a black hole where extra money goes every month.
It definitely can feel like a black hole. But if you look at it from the lender's perspective, they want to make sure you do not do anything that threatens the house. So this escrow account is essentially a forced savings account managed by the lender.
What specifically are they hoarding this money for?
The overarching term the guides use is property costs. At closing, you make an initial escrow payment. This is a cushion, often a few months' worth of expenses, paid upfront to pre-fund the account.
Okay, so you prime the pump, basically.
Right. Then, a fraction of your annual property costs is added to your monthly mortgage payment. The lender holds this money in trust, and when the massive annual or semi-annual bills come due, the lender pays them on your behalf.
So what are these property costs?
Yeah.
We know property taxes are one, homeowner's insurance is another. What else? I mean, are they holding money in case my roof caves in?
No, it does not cover physical maintenance. The bank expects you to handle that. Property costs strictly encompass external financial obligations that could threaten the property's legal standing or physical value.
So like HOA fees.
Exactly. Beyond taxes and homeowners insurance, this includes charges imposed by a condominium or homeowners association, ground rent, leasehold payments, and ongoing mortgage insurance premiums if your specific loan requires them.
Okay, so it is all the secondary costs of owning the home. And I can see why the bank cares. But what if I just don't want the bank acting as my financial babysitter? What if I am perfectly capable of paying my own taxes and insurance? The TRIDE rules mention waiving escrow.
You generally have the right to request an escrow waiver, though it really depends on the loan type and your overall credit profile.
Is there a catch?
There is a big catch. If you choose to decline an escrow account, the compliance manuals note that you will typically be charged an escrow waiver fee at closing. It can be 1/4 point of your total loan amount, which can be thousands of dollars.
Wait, I have to pay a massive fee to not let them hold my money. That feels completely counterintuitive. Why am I being penalized for managing my own bills?
You are being penalized because you represent a higher statistical risk to the lender. When you waive escrow, the lender completely loses control.
Oh, I see. They have to trust you to actually pay it.
Right. The closing disclosure explicitly warns that if you waive escrow, you must pay your property costs directly, usually in massive lump sum payments once or twice a year. If you suffer a job loss or if you simply fail to budget for a $5,000 tax bill, the consequences directly threaten the lender's collateral, your house.
Let's break down exactly how it threatens the collateral. Say I waive escrow, I fall on hard times, and I just stop paying my property taxes. What does the local government do?
The local government does not care about your mortgage one bit. If you fail to pay your property taxes, they will impose fines and penalties. If it goes on long enough, they will place a tax lien on the property.
And a lien is bad news.
It is terrible news, and here is the terrifying part for the lender. A government tax lien is almost always in first position. It supersedes the mortgage entirely.
Meaning the government gets to cut in line ahead of the bank.
Exactly. The government can legally foreclose on your home, sell it at auction to get their unpaid tax money, and completely wipe out the lender's security interest. The bank loses their hundreds of thousands of dollars just because you didn't pay your taxes.
Wow. Okay, that makes perfect sense. The bank is terrified of the IRS and the county assessor. What about homeowners insurance? Let's say I pay my taxes, but I let my homeowners insurance lapse because the premiums just got too high.
Well, if your insurance lapses, the property is entirely unprotected against fire, wind, or massive liability claims. If the house burns to the ground, the lender's collateral is literally reduced to ashes. They hold a mortgage on a vacant lot.
So they aren't going to just sit back and hope it doesn't burn down.
No, the treaty guidelines give the lender immediate authority to step in. If you let your policy lapse, the lender will force what is called lender-placed insurance onto your loan.
And let me guess, lender-placed insurance is not exactly a bargain.
It is astronomically expensive. The federal disclosure specifically warns consumers that insurance the lender buys on your behalf will likely cost significantly more than a policy you could source yourself.
And does it cover my stuff?
That is the kicker. It provides far fewer benefits. It often only covers the outstanding balance of the loan, not the replacement cost of your belongings or the full value of the home. It protects the lender, not you, but you are forced to foot the bill. They will simply add the exorbitant premiums right to your loan balance.
This completely reframes the escrow account for me. It is not a service they're providing to be nice. It is a rigid risk mitigation system to protect the collateral from external threats.
Precisely. And this intense focus on mitigating risk extends all the way down to the signature requirements on these Tri-ID disclosures. The truest federal compliance manual has entire chapters dedicated just to how these forms must be signed and retained.
Yeah, I noticed the Truist manual is incredibly specific about who has to sign based on whether the loan is rescindable or non-rescindable. Let's define those terms first. A non-rescindable loan is a standard purchase of a new home, right? You buy it, and it's done.
Generally, yes. A transaction to purchase a home is non-rescindable. You cannot wake up the next morning and decide you just don't want to buy it anymore. For these non-rescindable loans, the rules are straightforward. A copy of the final closing disclosure must be signed and dated by the borrower and any co-borrowers named on the loan.
That seems easy enough. But if we look at a rescindable transaction like doing a cash-out refinance on the home you already live in, the signature rules become much more complex.
Extremely complex. Because federal law grants you a 3-day right to cancel a refinance on your primary residence, the Truist manual dictates that the final CD must be signed and dated by the borrower, the co-borrower, any non-borrower who holds a right to rescind.
A non-borrower with a right to rescind, who would that actually be in the real world?
The most common scenario is a spouse. Let's say you own the home, but you are refinancing it solely in your name because your spouse has terrible credit.
Okay, so the spouse is not on the loan at all.
Right. Even though your spouse is not on the loan and has absolutely no financial obligation to repay the debt, they still live in the home. It is their primary residence. Because you are using their shelter as collateral for a new loan, federal law gives that non-borrowing spouse the legal right to cancel the transaction.
Oh, wow. So the bank requires absolute proof that the spouse received the disclosures.
They have to. The paperwork trail has to be bulletproof. Furthermore, the manual dictates that if the transaction involves separate closing disclosures for the borrower and the seller, which is common for privacy reasons, copies of the final version of each must be kept in the permanent mortgage loan file.
Okay, so the bank needs all these signatures perfectly executed on very specific dates by very specific people. They can't just mail you the paperwork and hope you do it right. They need a referee.
They need a highly regulated gatekeeper.
Exactly. And that brings us to the unsung hero of the entire financial system, the notary public. But real quick, speaking of experts in the field, make sure you check out our video podcast, No Notary, with Eddie Montes Travis, and you can also catch Marylyn's 90 Seconds of Notary.
Great content on both of those. Definitely check them out.
All right, so getting back to the notary. Drawing from the National Signing Services and Notary Training School manuals, we really see how misunderstood the notary is. Most people view notarization as just a bureaucratic rubber stamp, right? A minor inconvenience where you pay a guy at the shipping store $5 to stamp your document.
But reading these manuals, it is not a rubber stamp at all. It is a formal, highly structured fraud prevention ceremony.
I love that phrase, fraud prevention ceremony. It feels like an ancient ritual of oaths, seals, and witnesses. But it is the absolute bedrock of modern legal authenticity. Let's walk through the steps a notary must take, because the level of scrutiny is intense.
The first step is document review. And before the notary even looks at your ID, they must examine the document itself. The crucial rule here is that a notary must refuse to notarize an incomplete document.
Incomplete meaning missing pages.
Yes, there can be absolutely no missing pages, and more importantly, no blank spaces.
No blank spaces at all. What if there's a massive section for secondary cosigner and I just don't have one? I can't just leave it blank.
No, you cannot. You must cross it out, draw a line through it, or explicitly write NA for not applicable. In many states, notarizing a document that contains blank spaces is outright illegal.
Why are they so aggressive about a blank line?
Think about the fraud vector. If a notary seals a document with a blank paragraph, a malicious actor could take that document home, run it back through a printer, and add entirely new terms into that blank space.
Like a higher interest rate or an agreement to surrender the property.
Exactly. Because the document already bears the official notary seal, those fraudulent terms would appear to be legally binding and authenticated. The training guides explicitly warn that leaving blanks can completely invalidate the entire notarization in a court of law.
Okay, so the document is locked down, no blanks.
Well,
Step 2 is ID verification. Seems obvious, but I imagine the standards are rigid.
It is the absolute cornerstone of the process. The notary must identify you using a valid, unexpired, government-issued photo ID, a driver's license, a passport, or a state ID card. And the name on the ID must align perfectly with the name printed on the document.
What if my driver's license expired yesterday, but I have my Costco card and a utility bill?
The process halts immediately. The notary cannot proceed. Now, there is a very rare historical exception that still exists in some local jurisdictions. If a valid ID is truly impossible to obtain, the law sometimes allows for the use of credible witnesses.
Credible witnesses, like I bring a couple of friends who vouch for me.
Essentially, yes, but it is highly regulated. You would need one or two impartial individuals who personally know you, who themselves have valid ID, to physically stand before the notary, raise their right hands, and swear under penalty of perjury that you are who you claim to be.
That sounds intense.
It is an ancient legal concept kept alive for edge cases, but it proves how seriously the state takes the verification of identity.
So you have the document, you have the ID. Step 3 is choosing a notary. The National Signing Services source gives a few common options. You can go to a bank or credit union, which is often a free service if you hold an account there. You can go to a public library for minimal fees. But the manuals also spend a lot of time on RON. What is RON?
RON stands for Remote Online Notarization. It is the modern evolution of the process. RON utilizes highly secure, encrypted video conferencing technology to allow you to connect with a certified notary online.
So I can sit in my living room in my pajamas and sign my mortgage.
Yes, you can. It offers incredible convenience. But the security standards are actually much higher than in-person notarization.
How so?
Before you even get on camera, you usually have to pass a knowledge-based authentication test, answering obscure questions about your credit history, and you must scan your ID using software that analyzes the microprinting and holograms to detect fakes. Once you pass all of that, you join the video call, and the notary observes you digitally signing the document.
That is fascinating. It is taking the ancient ceremony and layering it with biometric security. So whether you are in person or on a RON platform, you reach the actual ceremony. What is the notary physically doing?
After verifying your ID, the notary must determine what kind of notarial act is required. This is dictated by the specific certificate printed at the bottom of the document. The two most common are an acknowledgement and a jurat.
What is the functional difference between an acknowledgement and a jurat?
An acknowledgement is exactly what it sounds like. You are acknowledging your signature. You are declaring to the notary that you are signing this document willingly, of your own free volition, and without any duress or coercion. The notary observes you sign it, or you acknowledge a signature you made previously.
So an acknowledgement is really about free will. What about a jurat?
A jurat is much more intense. A jurat is about truth. For a jurat, the notary is legally required to administer a spoken oath or affirmation. You must physically raise your right hand and swear out loud that the contents of the document you are signing are true and correct to the best of your knowledge.
So you are basically testifying under oath right there at your kitchen table.
Yes. You are subjecting yourself to the penalties of perjury. That physical friction, raising the hand, speaking the words out loud, is designed to make the signer stop and realize the gravity of what they are executing.
After the oath and the signing, we hit the final step. Seal and record.
Right. The notary applies their official physical or digital seal. This seal is tightly regulated by the state and must clearly display the notary's name, their state commission number, and the state of jurisdiction.
But the seal is only half the job, right?
Exactly. The notary must then record the entire event in their sequential journal.
And reading the requirements for this journal, it is basically a forensic log.
It is a permanent legal record. The notary must log the date and exact time, the type of document, the specific names of every signer, the exact method used to identify them, including ID serial numbers, and the type of notarization performed.
Why keep such an intense logbook?
Because if a mortgage is ever challenged in court 5 years later, say a spouse claims their signature was forged, the notary's journal is the ultimate piece of evidence. The notary can produce the journal and say, look, on this date at 2:15 p.m., this person presented this specific passport, and I watched them sign. It protects the integrity of the entire legal system.
Now, the Notary Training School manuals highlighted two specific quirks about this process that I really want to unpack because they are so counterintuitive. First is a minor one, the issue of pronouns on the notarial certificate.
Ah, yes. Often these certificates are printed with boilerplate text that says, Heshithe appeared before me. The question that paralyzes a lot of new notaries is, do I need to explicitly circle or underline the specific pronoun that applies to the signer?
Yeah, like if a man signs and I don't cross out she and they, is the document void? It sounds like a typo waiting to happen. Does it matter?
The answer is that it varies slightly by state law, but broadly speaking, it actually does not matter. The fundamental purpose of the certificate is to document the act that took place. As long as the certificate accurately reflects the identity of the person and the act of notarization, failing to circle a pronoun will not invalidate the entire transaction. Courts look at the substance of the act, not minor typographical formatting.
Okay, that is a relief, for sure. But quirk number 2 is the one that really blew my mind. I want to spend some time on this. Notary bonds.
This is perhaps the most misunderstood concept in the entire field.
So when a notary gets commissioned by the state, many states require them to purchase a notary bond for a set amount, say $10,000, before they can buy their stamp. Instinctively, when I hear bond or insurance, I assume it is to protect the notary, like a doctor buying malpractice insurance. If the notary messes up, the bond covers them so they don't lose their house in a lawsuit.
That is the assumption everyone makes, and it is entirely, completely false. A notary surety bond offers absolutely zero protection to the notary. It is designed to protect the public from the notary.
Wait, explain the mechanism of this. How does it protect the public?
Let's use a hypothetical. Imagine a notary acts negligently. They fail to check an ID properly, and they notarize a forged deed. The fraudster takes that deed, sells a house they don't own, and steals $10,000 from an innocent buyer.
Okay, so the buyer is out 10 grand.
Right. That buyer has been financially harmed because the notary failed to perform their duty. The buyer can make a claim against the notary's bond. The surety company that issued the bond will immediately pay the victim that $10,000 to make them whole.
Okay, so the victim gets their money back. But what happens to the notary? Does the surety company just absorb the loss like a normal insurance claim?
No. And this is the critical difference between a surety bond and traditional insurance. Traditional insurance assumes the risk. A surety bond does not. Once the surety company pays the $10,000 to the victim, they will turn around and ruthlessly pursue the notary to recover every single cent.
Wait, really?
Yes, they will sue the notary, garnish their wages, and put liens on their assets until the notary pays back the $10,000.
That is wild. The state forces a private citizen to buy a financial product that pays out to someone else, knowing full well the company will then hunt the citizen down for the debt.
Exactly. Because the state is deputizing a private citizen to act as a public official, the state demands a financial guarantee that the public will not be harmed by that official's incompetence. The bond ensures there is always a pot of money available for victims, regardless of whether the notary is personally bankrupt.
So if the bond doesn't protect the notary, what does? How does a notary sleep at night knowing one mistake could bankrupt them?
If a notary wants actual protection from liability, they must purchase a completely separate product on their own dime called errors and omissions, or E&O insurance. E&O insurance is traditional malpractice insurance. If the notary is sued for a mistake, the E&O policy pays for their legal defense, and it pays out the damages without requiring the notary to pay it back. But the state does not require E&O. They only require the bond for public safety.
That fundamentally changes how I view the notary. They are carrying an immense burden of liability. The state has essentially outsourced the policing of financial transactions to them and put their personal finances on the hook to guarantee their performance.
Which is why a good notary is meticulous, strict, and unbending on the rules. And this perfectly sets up the next major concept. Because when a notary makes a mistake, or when a lender makes a mistake in this highly regulated environment, the consequences trigger some of the most aggressive federal consumer protections in existence. Let's look at the Truth in Lending Act, specifically Regulation Z, and the 3-day right of rescission.
We touched on this briefly when we talked about signatures on refinance loans. Let's dive deep into the Notary Training School and the NCLC Digital Library case law regarding this right of rescission.
Regulation Z is the implementation of the Truth in Lending Act, and one of its most powerful provisions is the right to cancel. When a borrower refinances their primary residence or takes out a home equity loan, federal law guarantees them 3 precise business days to completely cancel the transaction for any reason with absolutely no penalty.
We talked about the psychology of this earlier, the cooling off period to prevent predatory lending. The borrower has 3 days to review the paperwork, talk to a lawyer, or just get cold feet.
Yes. The tension here at the closing table is palpable. You have the borrower, who usually wants their money immediately. Maybe they're doing a cash-out refinance to pay for emergency roof repairs or desperate medical bills. They are intensely frustrated that they have to wait 3 days.
And on the other side,
On the other side, you have the government enforcing this mandatory pause to protect the primary residence. The notary is caught directly in the middle, and their job is to execute the paperwork perfectly so that the 3-day clock starts exactly when it is supposed to.
and the stakes for getting this wrong are astronomical. The notary training school manuals drill into this repeatedly. They say counting this 3-day window incorrectly is one of the costliest mistakes a signing agent can ever make.
It really is. A miscounted rescission date can delay the funding, violate Regulation Z, and completely destroy a notary's relationship with the title companies that hire them.
Because if the notary puts the wrong date on the notice of right to cancel, the entire transaction is in jeopardy. Okay, let's explore that jeopardy. What actually happens if the paperwork isn't perfect? Let's say it's an honest mistake. The notary is tired, they look at a calendar wrong, and the dates written on the notice of right to cancel are misstated by 1 day, or perhaps left blank entirely.
If you dig into the legal indices of the NCLC Digital Library, specifically the dense truth in lending case law, there is a fascinating and truly nuclear provision. According to the law, if the dates on the rescission notice are misstated or omitted, the rescission period is extended.
Extended by how much? Does the clock just restart so they get another 3 days?
No. If the disclosure is defective, the right to rescind can be extended for up to 3 years.
3 years.
3 years from the date of consummation.
Wait, we need to pause and unpack a hypothetical scenario here because that is unbelievable. You are telling me a family could refinance their house, they sign the papers, the notary accidentally writes October 15th instead of October 16th on the cancellation notice.
Yeah.
The loan funds. The family uses the money. 2.5 years pass.
Yep, keep going.
The family struggles to make payments. They talk to a clever lawyer. The lawyer looks at the original paperwork, finds that typo on the date, and the family can just cancel a mortgage they've had for almost 3 years.
That is precisely what it means. The legal theory is that the 3-day clock only starts ticking when the consumer receives a clear, accurate, and legally compliant notice of their rights. If the notice is defective, the clock never legally started. Therefore, the right to cancel remains open for the statutory maximum of 3 years.
That is a complete nightmare for the bank. What are the mechanics of unwinding a loan 2.5 years later? It can't be simple.
It is catastrophic for the lender. When a consumer exercises this extended right to rescind, several things happen immediately by operation of law. First, the lender's security interest in the home becomes completely void. The mortgage is instantly dissolved. The house is no longer collateral.
So the bank is suddenly holding an unsecured loan for hundreds of thousands of dollars.
Exactly. Second, the borrower is no longer liable for any finance charges, interest, or fees associated with the transaction. The lender must refund every single penny the consumer paid in closing costs, appraisal fees, broker fees, and all the interest paid over those 2.5 years. The lender has to cut a massive check back to the borrower.
What about the principal? Does the borrower just get a free house?
No, they do not get a free house. They do have to return the principal amount they actually borrowed, minus all those refunded fees and interest, but the leverage completely flips. Because the bank no longer has a lien on the house, the borrower has immense power to negotiate a favorable settlement or a modified payment plan to return that principal. The lender is terrified of losing everything.
The punishment seems wildly disproportionate to the crime. A 1-day typo on a calendar results in the bank having to refund tens of thousands of dollars in interest and losing their lien. Why is the law written to be this radioactive?
It is deliberately designed to be punitive. It is a strict liability statute. The government recognizes that they do not have enough regulators to sit at every closing table and audit every transaction. So they created a penalty so severe, so financially catastrophic, that the banks are forced to achieve absolute perfect precision in their disclosures.
So it forces the banks to audit themselves.
Yes. The banks spend millions on compliance software and audits because they know a single typo can cost them hundreds of thousands of dollars 3 years down the road.
And this perfectly transitions us to the broader implications of these rules. We just saw how a typo on a date can void a mortgage. Let's pull back and dive deep into the NCLC Digital Library's analysis of Truth in Lending Act liability as a whole. What happens when the system breaks in other ways?
The Truth in Lending Act, TILA, is the bedrock of consumer finance protection, and it provides consumers with incredibly sharp legal teeth to enforce these regulations. When a lender violates TILA, whether through bad disclosures, hidden fees, or ignoring rescission rights, the law allows consumers to sue to recover both actual damages and statutory damages.
Let's define those for the listener. Statutory damages seem straightforward. They are a fixed penalty amount set by the statute, right? You prove the violation happened, the law says the penalty is $2,000, and you get $2,000. It doesn't matter if you were actually hurt by it.
Exactly. Statutory damages are a penalty for breaking the rules, but actual damages are much more complex.
Actual damages sound like you have to prove you lost real money.
You do. And historically, courts made this very difficult for consumers. They required a legal standard known as detrimental reliance to award actual damages.
Detrimental reliance. Breaking that down, it means I have to prove that I relied on the lender's mistake to my own detriment, that their lie directly caused my financial harm.
Precisely. Let's say a lender understated the annual percentage rate on your disclosure. To win actual damages under the old standard, you would have to prove to a judge that you read that specific disclosure, you believed the false APR, and because you believed it, you declined a better loan offer from a competing bank, thereby suffering a quantifiable monetary loss over the life of the loan.
That is almost impossible for an average consumer to prove. I mean, who keeps competing loan offers in a file for years just in case?
Very few people, which meant lenders often got away with deceptive practices because actual damages were too hard to prove. But the NCLC indices highlight a crucial modern shift in legal thinking regarding detrimental reliance.
A shift in favor of the consumer, I assume.
Yes. Modern courts and legal advocates are successfully arguing that detrimental reliance should not be required in situations where the TILA violation does not hinge on a disclosure issue.
Okay, I need an example to ground this. What is a TILA violation that isn't about a bad disclosure form?
Let's look at auto financing. Say you go to buy a car, and the finance manager secretly packs a dealer upcharge or a hidden kickback fee into the total financed amount. They don't disclose it incorrectly. They simply hide it completely in the math. They stole $1,000 from you by inflating the principal.
So it's not that I read a bad form and relied on it. It's that they literally picked my pocket through a hidden mechanism.
Exactly. In cases of hidden payments or illegal upcharges, the modern legal argument is that the actual damage is the stolen money itself. The consumer should not have to prove they detrimentally relied on anything to get their stolen money back. The injury is self-evident.
That makes total logical sense. If a pickpocket takes my wallet, I shouldn't have to prove I was going to use that cash to buy groceries to get the judge to order the thief to return it. The theft is the damage. Now, here is a concept from the NCLC source that I really want to challenge, because on its face, it seems fundamentally unfair. Assignee liability.
This is one of the most critical structural mechanisms in all of modern mortgage law.
Let's set up this scenario. My original lender, Bank A, writes a mortgage for me. Bank A makes a mess of it. They violate TILA, they hide fees, their paperwork is atrocious. A week later, Bank A sells my mortgage to Bank B on the secondary market. Bank B is the assignee. According to the NCLC source, Bank B, the new owner of the loan, is now liable for Bank A's TILA violations, if those violations are apparent on the face of the documents. Furthermore, assignees are fully subject to rescission. If Bank A messed up the dates, I can cancel the loan against Bank B.
That is exactly how the law works.
Well, why? I need to use an analogy here. It feels like buying a used car. If I buy a used car from a guy on the street and it turns out he stole it, the police don't just take the car back. Under this logic, I would be prosecuted for the original theft. Why should a massive financial institution that just bought a loan on the secondary market be punished or have their asset voided because of the sloppy paperwork of the original originator? It seems unfair to the buyer.
It absolutely seems unfair if you look at it in isolation, but you have to look at the macroeconomic purpose of TILA. This assignee liability is a deliberate, engineered mechanism to force the free market to regulate itself.
Walk me through the engineering. How does punishing the buyer fix the market?
You have to look back at the historical context, particularly the build-up to the 2008 financial crisis. You had originators, small, aggressive lenders writing terrible, non-compliant, highly predatory loans. But they didn't care if the loans were toxic because they never intended to keep them. They would originate the loan on Monday, collect their origination fee, and sell the toxic loan to a Wall Street investor on Tuesday. They wiped their hands clean.
So the originators had no skin in the game.
None. And if the assignees, the Wall Street buyers of the debt, held no liability, they would just blindly buy up these toxic loans in massive bundles without caring how they were made. This created an infinite demand for predatory origination. Wall Street funded the predatory machine because they suffered no consequences for buying toxic assets.
I see where this is going. By establishing assignee liability, TILA changes the math for Wall Street.
Precisely. By making the assignee legally liable for violations apparent on the face of the documents, and by making them subject to rescission, TILA forces the buyers to do their due diligence. It forces them to look at the VIN of the used car before they buy it.
If the secondary mortgage market knows they will face lawsuits or have their multi-million-dollar loan bundles voided just because they bought sloppy, non-compliant loans, they are going to stop buying them.
Exactly. Wall Street will suddenly refuse to purchase loans from originators who have bad paperwork. And if the originators cannot sell their loans to Wall Street, they go bankrupt. Therefore, the originators are forced by the free market to follow the law perfectly. The government essentially deputized the multi-billion-dollar secondary market to police the Main Street lenders. It shifts the burden of auditing millions of pages of paperwork from an underfunded government agency onto the financial institutions themselves.
That is brilliant. It uses the greed of the secondary market to enforce compliance on the primary market. But what about the consumer? Let's say I find a TILA violation. I want to sue the bank. I'm a normal person. The bank has a skyscraper full of lawyers. The damage might only be $2,000 in hidden fees. No lawyer is going to take my case because the legal fees would be 10 times the damages. How does TILA actually give a normal person a fighting chance?
It gives them a chance through one of the most powerful provisions in the entire Act, the attorney fees provision.
The NCLC index dedicates a huge section to this, right?
Yes. If a consumer successfully concludes a TILA action, even against these massive assignees, or in cases of enforcing rescission, they are legally entitled to have their attorney fees paid by the lender.
This is a game changer. This means I can hire a top-tier consumer protection attorney without paying them a dime out of pocket, because if we win, the bank pays their hourly rate.
Exactly. This is what makes TILA actually enforceable. It is a fee-shifting statute. And the NCLC manual notes that this covers a vast array of legal work to ensure the attorney is fully compensated. It covers the initial trial preparation, the trial itself, appellate work if the bank tries to drag it out in higher courts, post-judgment work to actually collect the money, and it even mandates that fees must be paid to legal services organizations or nonprofit attorneys doing pro bono work.
How do they calculate how much the bank has to pay the lawyer?
Courts generally use what is called the lodestar approach. They multiply the allowable hours the attorney worked by a reasonable market hourly rate for someone of their experience level. This ensures that skilled lawyers are financially incentivized to take these complex consumer protection cases, even if the actual damages awarded to the consumer are relatively small.
Now, here's the kicker, and I want to make sure I'm reading the index correctly. If I sue the bank under TILA and I lose, the judge says the bank did nothing wrong. Do I have to pay the bank's massive corporate legal fees?
You do not. There are absolutely no TILA attorney fees awarded to prevailing creditors.
None. It is entirely a one-way street.
It is a one-way fee-shifting statute. It is designed entirely to empower the consumer. If the consumer had to risk paying the bank's legal fees if they lost, no one would ever dare sue a bank. The terror of being bankrupted by corporate lawyers would completely chill the enforcement of the law. The one-way street balances the scales of justice between a massive financial institution and a single consumer sitting at a closing table.
We are seeing a massive theme here. Every piece of this machinery, from the 3-day wait to the notary bond to the assignee liability to the attorney fees, is a deliberate injection of friction designed to protect the structurally weaker party.
That is exactly right.
Now, just to round out the NCLC index, there are a few other consumer protections worth mentioning before we wrap up that section. There are strict rules on advertising, right?
Yes, TILA heavily regulates how credit can be advertised to prevent bait-and-switch tactics. If a lender runs a commercial and uses what the law calls triggering terms, like stating a specific low monthly payment or a specific down payment amount, that ad must then clearly and conspicuously disclose the annual percentage rate and the full terms of repayment. They cannot lure you in with a promise of $99 a month without explaining the massive balloon payment hiding at the end.
The index also mentions Dodd-Frank appraisal standards. This ties right back to the 2008 crisis as well, doesn't it?
Absolutely. During the housing bubble, originators would heavily pressure appraisers. They would tell the appraisers, we need this house to appraise for $500,000 to make the loan work, and if you don't hit that number, we won't hire you again. This led to massively inflated property values.
Which obviously crashed the market.
Right. So Dodd-Frank introduced strict standards requiring total independence for appraisers. It explicitly prohibits any coercion, bribery, or conflicts of interest. The lender cannot communicate with the appraiser about the target value.
And finally, a small but very important practical note for our listeners on interacting with government oversight. If you ever submit an inquiry, a complaint, or a comment to regulatory bodies like the CFPB, like responding to the Federal Register request for information mentioned in our sources, you have to be careful what you say.
Yes, you really do. Your submission becomes part of the permanent public record. It can be viewed by anyone on the internet. So always heavily redact and exclude sensitive personal information like account numbers, social security numbers, or detailed financial histories from your public comments. It's a vital way to participate in the regulatory process, but you must protect your own data.
Okay, we have covered an immense amount of ground. But now it is time for everyone's favorite segment. It is time for Mastering Real Estate Closings, Test Your Knowledge Tuesday.
I love this segment. Let's see what everyone has learned today.
Today's topic focuses on escrow documents and some real-world notary scenarios. I have 10 multiple-choice questions. I will read the hook, the question, and the options. We'll give you a few seconds to think and then reveal the answer. Are you ready?
I am ready. Let's go.
Question 1. When setting up an escrow account at closing, you pay an initial escrow payment. What is the primary purpose of this payment? A. To pay the real estate agent. B. To pre-fund the account with a cushion for future property costs. Or C. To pay for the first year of maintenance repairs.
1, 2, 3. The answer is B. It acts as a cushion to ensure there is always enough money to cover recurring property costs like taxes and insurance.
Spot on. Question 2. If you decide to waive an escrow account, what is the most likely consequence from the lender? A. They charge you an escrow waiver fee. B. They lower your interest rate. Or C. They require you to pay off the loan in 5 years.
1, 2, 3. The answer is A. They will likely charge you a hefty escrow waiver fee because you are now a higher risk to the collateral.
Perfect. Question 3. Why are lenders so terrified of a borrower failing to pay their property taxes? A. The lender's credit score drops. B. A government tax lien supersedes the mortgage and can wipe out the lender's security interest. Or C. The county will seize the lender's corporate headquarters.
1, 2, 3. The answer is B. The government always cuts in line, and their tax lien can completely wipe out the bank's mortgage.
Exactly. Question 4. If your homeowner's insurance lapses, the lender will force lender-placed insurance on the property. What is a major downside of this? A. It only covers the lender's interest and is highly expensive. B. It only covers flood damage. Or C. It requires a new appraisal.
1, 2, 3. The answer is A. It costs a fortune, and it really only protects the bank, not your personal belongings.
Right. Okay, moving into some real-world notary scenarios. Question 5. Let's look at Greg in Nevada. Greg is notarizing an escrow waiver form, and his notary stamp smudges terribly, making his commission number unreadable. What should he do? A. Write his commission number in pen next to it. B. Affix a new, clear impression near the smudged one if there is room. Or C. Cross out the entire document and make them reprint it.
1, 2, 3. The answer is B. As long as there is room, he should affix a near clear impression. Never try to alter or write over a smudged seal.
Very good. Question 6 features Mia in Oregon. Mia is handling a high-stakes escrow deed for a commercial property. When she fills out her journal, does she generally need a thumbprint from the signer? A. Yes, for deeds affecting real property, it is often a best practice or state requirement. B. No, thumbprints violate privacy laws. Or C. Only if the signer doesn't have an ID.
1, 2, 3. The answer is A. In states like California, and often as a best practice in high-risk real estate deeds elsewhere, capturing a thumbprint in the journal provides ultimate forensic proof of identity.
Nailed it. Question 7. Leo in Utah is rushing through an escrow closing because the borrower is in a hurry. He wants to skip administering the spoken oath for a jurat and just have them sign. What is the consequence? A. It saves 5 minutes. B. It legally invalidates the jurat because the oath is mandatory. Or C. He has to charge less.
1, 2, 3. The answer is B. It completely invalidates the jurat. You cannot skip the spoken oath.
You cannot cut corners. Question 8. Eva in Colorado loses her notary journal, which contains all her escrow closing records for the past year. What is her very first required step? A. Buy a new one on Amazon. B. Immediately notify the Secretary of State or commissioning authority. Or C. Call all the borrowers and apologize.
1, 2, 3. The answer is B. She must immediately notify the Secretary of State or the proper local authority that her permanent legal record has been compromised.
Exactly. Question 9. Sarah in New Hampshire is asked by a title company to email a copy of her journal entry for a specific escrow closing to resolve a dispute. However, the page contains information about other unrelated signers. How does she handle privacy? A. Send the whole page, it's public record. B. Provide a copy but heavily redact or cover the information of all other signers to protect their privacy. Or C. Refuse the request entirely.
1, 2, 3. The answer is B. She must redact or cover all other entries. She can only provide the specific line item requested to protect the privacy of the other citizens in her journal.
Excellent. And our final question, number 10. On a rescindable loan transaction, like a primary residence refinance, who must sign the final closing disclosure? A. Only the primary borrower. B. The borrower, co-borrower, and any non-borrower with the right to rescind like a spouse. Or C. The notary and the loan officer.
1, 2, 3. The answer is B. The borrower, co-borrower, and D. Any non-borrowing spouse with a legal right to cancel the transaction must sign.
10 for 10. Fantastic job.
That was a great review.
All right, let's take a breath and bring this all together. We started this hour by looking at a simple signature and a closing disclosure, a moment that feels like a finish line. But we have uncovered an incredible, hidden, staggering machinery operating beneath the surface.
We explored the mandatory 3-day wait periods, the psychology of the closing table, and the complex escrow mechanisms dictated by Tri-D to ensure local governments and insurance companies don't threaten the collateral.
We walked through the rigid, fraud prevention rituals of the notary public. We learned that they are not just stamp wielders, but financially bonded gatekeepers against forgery, operating under the threat of aggressive surety companies.
And we dug deep into the massive liability teeth of the Truth in Lending Act. We saw how a single missing date can trigger a 3-year right of rescission, how modern legal theory is shifting away from detrimental reliance to punish hidden fees, how assigned liability forces Wall Street to police Main Street lenders, and how one-way attorney fees give everyday consumers the financial power to fight back against corporate giants.
It is a massive ecosystem of friction designed entirely to protect you, the consumer, which actually brings up a genuinely fascinating consideration for the future.
It does. Everything we discuss today relies on friction. We rely entirely on the physical, human ceremony of the notary looking you in the eye. We rely on the literal, agonizingly slow ticking of a 3-day cooling-off clock to protect consumers from life-altering financial mistakes made under duress. This friction is our ultimate safety net.
Right. The system intentionally slows us down to force us to think.
But look at where the financial world is heading. We are racing towards smart contracts, blockchain technology, and instantaneous digital ledgers. The entire tech industry is obsessed with frictionless transactions.
So we face a profound challenge. How will we code the nuance of human willingness into a blockchain? How does a perfectly efficient algorithm verify a lack of duress when a digital wallet is instantly pinged for a signature via facial scan? How do you enforce a deliberate 3-day cooling-off period in a technological ecosystem built entirely on instant, irrevocable, frictionless execution?
It is the defining regulatory and philosophical question of the next decade of finance.
Will the drive for zero-friction digital closings ultimately strip away the psychological and legal safety nets that this highly regulated human friction currently provides? That is a terrifying thought to leave you with. Think about that the next time you are asked to click a button and quickly e-sign a major financial agreement on your phone. Because when the frictionless machinery of modern finance breaks down, you want to make sure you aren't left stranded without those old-school protections.
And if you have any questions about today's show or any of these concepts, we want to hear from you. Email your questions to derek@dereksproul.com. We will try to answer as soon as possible at the end of our shows.
Don't just be listeners of the knowledge, be doers of the knowledge. This is Notary Knowledge. Until next time.
We'd like to thank our amazing team. Credits to our executive producer, Derek Sproul, lead writer Marylyn Lee Trotter, graphics by Eddie Montes Travis, music by Thomas Bynum.
And proudly produced by Magnificent Works Business Solutions. Thanks for joining us.
Since you started your notary business, strive for excellence. Introducing the book, Notary Operational Excellence by Derek Sproul. Build your business on a beacon of precision and trust with expert advice. Check out Notary Operational Excellence by Derek Sproul from Amazon.com, Barnes & Noble, Books of Million, Bookshop.org, Mobile Notary by DerekSproul.com, or download from Kindle today.
Time to elevate.